Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at eBay.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And a quick note before we get into today's stock. If you need emergency cash and want to look at a short-term installment loan option, you can check out MaxLend Loans through my link below. Eligible customers may qualify for loan options up to $3,750, and funding may be available quickly if approved. But please be careful. Always read the full loan agreement, APR fees, repayment schedule, and total cost before signing anything.
So we are looking at a situation today that honestly completely redefines the mechanics of corporate takeover.
Oh, absolutely. It's wild.
Right. Because for the past few years, the market has treated meme stock rallies as these isolated, somewhat chaotic events.
Yeah, mostly driven by retail traders.
Exactly. But today we are seeing those exact mechanics being weaponized for a highly calculated legacy corporate raid. Like GameStop has just launched a staggering $56 billion hostile takeover bid for eBay.
It is an absolute market earthquake. I mean, you rarely see a move this aggressive in the market.
Especially given the sheer size mismatch between the two companies, right?
Yeah, that's exactly what makes you stop and stare at the math here. GameStop is sitting on a market cap of around $12 billion.
Right.
Meanwhile, eBay is an e-commerce pioneer worth roughly $46 billion. So a $12 billion company trying to forcefully swallow a $46 billion giant.
It's the fish trying to swallow the whale.
Exactly. It completely defies all traditional logic of mergers and acquisitions.
It really does. It makes you wonder if this is just, another stunt to pop GameStop's stock price, or if they have genuinely engineered the financial leverage to pull off the corporate coup of the decade.
And I think it's entirely natural to be skeptical of that. Because traditional M&A, it usually involves the larger entity absorbing the smaller one.
Right, utilizing an established war chest of cash, pristine credit, all that.
Exactly. But when you look at the complex structuring of this offer, the premium involved, and honestly, the sheer audacity of the financial engineering behind it, you have to take it seriously.
Yeah, this isn't just a rumor.
No, this is a formalized, legally binding bid, and it immediately alters the landscape for both companies.
All right, let's move into the wealth building context. Because as sensational as the headlines are, you as a long-term investor need to know what this actually means for your portfolio.
Right. And for long-term investors, the key is looking past the initial shock value.
You have to see the underlying market mechanics that were just triggered.
Exactly. This isn't just a fleeting retail trading frenzy where a stock spikes for a few hours and then crashes back to reality. This is a major event-driven catalyst.
Right.
And it establishes a definitive valuation floor for a mature tech company.
Wait, so when you say a valuation floor, you mean that regardless of whether GameStop actually succeeds in buying eBay or if the deal falls apart completely?
GameStop has permanently stamped a $56 billion price tag on the company.
For the rest of Wall Street to see.
Exactly. Think of it like real estate. Imagine you live in a nice, somewhat older neighborhood where houses reliably sell for around $500,000.
Okay.
Suddenly, a highly motivated buyer comes in and publicly offers 30% over the asking price for the house right next door to yours. And they offer all cash.
Wow. Okay. So even if that specific sale eventually falls through, because of an inspection issue or whatever, the entire neighborhood just changed.
Yes. The comparable sales metrics, the comps, are completely altered.
It forces everyone in the housing market to fundamentally reassess the intrinsic value of the properties on that street.
And that is the exact mechanism at play here with eBay. For you as an investor, this aggressive bid highlights the hidden wealth embedded in eBay's specialized marketplace.
It violently flips the prevailing narrative.
It really does. Right? Because for years, the broader market has viewed eBay as a somewhat stagnant legacy platform.
It's kind of living in the shadow of Amazon.
Right. But this hostile bid reveals eBay as an undervalued cash cow. It has incredibly sticky consumer habits, and clearly, an outside party is willing to pay a heavy premium to acquire it.
Well, if GameStop is willing to bet the entire farm on that cash cow, we need to see how much milk it's actually producing.
Now let's look at the fundamentals.
Let's break down the core engine. Because eBay maintains a highly robust asset-light marketplace model.
Yes, very different from Amazon or Walmart.
Right. eBay isn't managing massive fulfillment centers. They aren't holding billions of dollars of their own inventory.
They simply facilitate the transaction and take a cut.
And that highly efficient model has built their current $46 billion market cap. Looking at the numbers, in fiscal year 2025, their top-line revenue grew by 8%.
And they added 1 million net active buyers.
Which is huge. That brings their total active buyer base to a remarkable 135 million people.
Having a network of 135 million active buyers is an incredibly valuable data set.
But what is the real moat here? Because a lot of people just assume, the e-commerce sector is entirely dominated by Amazon, leaving everyone else to fight for scraps.
The moat is their unparalleled consumer-to-consumer network effect. Specifically, they absolutely dominate high-margin collectibles and lifestyle verticals.
Right.
Like, if you are a hobbyist looking to buy a rare, authenticated vintage trading card,
Yeah.
or a highly specific refurbished car part, or high-end authenticated sneakers, you do not go to Amazon.
You go to eBay.
Yeah.
Because that is where the specialized liquidity is.
Precisely. And they have been aggressively fortifying this moat with highly strategic acquisitions.
Oh, right, like TCG Player.
Exactly. They bought TCG Player, which is essentially the apex marketplace for the trading card game community.
They also bought Golden Auctions, right?
Yes, to capture the ultra-high-end sports memorabilia market. And they have a pending $1.2 billion deal for Depop.
To capture the lucrative Gen Z secondhand fashion market?
Exactly. These acquisitions create massive switching costs. I mean, if all the buyers for vintage watches are on eBay, the sellers have to be there too.
It's a closed loop.
It is. Furthermore, they are heavily investing in smart payment infrastructure. They recently collaborated with TrueLayer in the UK to offer pay-by-bank options.
Which diversifies their payment mix away from traditional credit cards.
And it slashes the transaction costs they have to pay to payment processors, keeping more revenue in-house.
Okay, I understand the strength of the network effect there, but I do have an analytical pushback here regarding their margin profile.
Okay, Sarah.
You mentioned top-line revenue grew 8%, but if you dig into the income statement, their product development expenses grew by 11%.
Yes.
If the cost to build and maintain your platform is growing faster than the revenue the platform generates, I mean, that is a structural margin concern that eats into profitability over time.
That is a very valid concern. And ironically, it is exactly the inefficiency that GameStop is targeting with this takeover.
Wait, really?
Yeah, they aren't buying eBay because it's running perfectly. They are buying it because they believe it's bloated.
Okay, so they see fat to trim.
Exactly.
Yeah.
Under GameStop's proposed operational framework, they believe they can execute rigorous cost optimization.
Interesting.
They are projecting that by eliminating redundancies, they can surge eBay's diluted GAAP earnings per share from $4.26 today all the way to an impressive $7.79.
In year one.
In year one post-acquisition.
Let me stop you there, because going from 426 to 779 in generally accepted accounting principles earnings per share in a single year, that is an incredibly aggressive optimization target.
It's massive.
That means they have to find billions of dollars in savings almost overnight. How do they actually plan to achieve that?
By drastically cutting the very product development bloat you just pointed out, consolidating administrative overhead, and crucially, leveraging GameStop's physical retail footprint.
How does the retail footprint help eBay?
GameStop believes they can integrate eBay's physical authentication services, like verifying the authenticity of those expensive trading cards or sneakers, directly into thousands of existing GameStop retail locations.
Wow.
Right. That would severely cut down on eBay's independent shipping and logistics costs for authentication.
That is a fascinating strategic synergy, but executing it requires getting the deal done first. That brings us to the catalyst timeline.
Yes, and we are looking at a highly event-driven timeline over the next 3 months.
So what's the first domino to fall?
The very first immediate catalyst is the HSR regulatory filing by GameStop.
The Hart-Scott-Rodino filing.
Exactly. It's a mandatory notification of the federal government whenever a large merger is proposed, allowing antitrust regulators to review it.
That kicks off the formal institutional scrutiny.
It does.
And once that is filed, the ball is entirely in eBay's court. So as an investor tracking this, what is the crucial reaction we are watching for from eBay's board of directors?
Well, the board essentially has 3 options. They can accept the premium and negotiate the sale. They can reject the offer outright as inadequate. Or they can implement a defensive measure known as a poison pill.
The poison pill. That's a shareholder rights plan, where the board intentionally floods the open market with new discounted shares, right?
Yes. This dilutes the hostile bidder's ownership stake, making the takeover prohibitively expensive to complete.
And if the board resists and deploys a poison pill, an aggressive proxy fight becomes highly likely.
Almost guaranteed.
GameStop would bypass the board entirely and appeal directly to eBay's shareholders, asking them to vote the current board of directors out and replace them with people who will approve the sale.
Exactly. And we know GameStop's leadership has an immense motivation to push this through.
The motivation is staggering. We have to look at the aggressive driver behind this, Ryan Cohen, GameStop's CEO.
His compensation is tied to a massive, performance-based stock option award.
Right. If GameStop successfully executes this merger and reaches a $100 billion combined market cap,
His personal award is worth roughly $35 billion, if fully earned.
$35 billion. That is an almost unfathomable personal financial incentive to force a massive acquisition across the finish line, regardless of the friction.
Exactly. And there is one more major timeline catalyst: eBay's upcoming Q2 2026 earnings report.
Right, because eBay has already forecasted revenue that sits above Wall Street's current estimates.
Yeah. If they deliver a massive beat on those earnings, it proves to the market that their standalone turnaround strategy is already working without GameStop's help.
Which could actually force GameStop to raise its bid even higher than the current offer just to keep eBay's shareholders interested in selling.
Yes, and if they are forced to raise the bid, the trading floor is going to go wild. Now let's pivot to the chart.
Because when news of a $56 billion premium takeover hits the wire, the technical profile of a stock violently shifts.
Oh, it completely breaks the chart. Before this news broke, eBay closed at $104.07. After hours, the stock immediately gapped up 13 to 14%.
Wow.
Yeah, completely breaking out of its previous resistance levels and entering uncharted territory.
GameStop's official offer is $125 per share. To put that in perspective for you listening, that represents a 27% premium to the 30-day volume-weighted average price, or VWAP.
And a 36% premium to the 90-day VWAP.
Right. And VWAP is a crucial metric that institutional algorithms use to gauge the true average price of a stock based on trading volume over time.
Exactly. So offering a 36% premium over a 3-month average is a very loud statement to institutional holders.
It absolutely resets the stock's trading range. That $125 mark acts as a magnetic new ceiling for the stock's price action.
It really does.
Here's the market mechanics insight that I find most fascinating about all this. Because 125 is the new psychological target, it creates a classic M&A arbitrage setup.
Right, the merger arbitrage.
Yeah. For you listening, M&A arbitrage is when a trader looks at the $125 offer and compares it to the current trading price, which might be sitting at, say, $118.
That $7 gap exists because the broader market is pricing in the mathematical probability that this deal falls apart.
Exactly. Whether from financing collapsing or regulators stepping in to block it,
Right.
traders will buy at 118, betting that the deal successfully closes at 125, allowing them to pocket the difference.
But if the deal breaks, that stock plummets right back to 104.
It is a high-stakes game of probability. But you know, what really caught my eye wasn't just the arbitrage. It was the heavy institutional flow and options activity that preceded this public announcement.
Oh, this is the best part.
GameStop didn't just wake up and launch a bid. They quietly built a 5% economic stake in eBay prior to the news.
That is a critical point regarding the mechanics of this move.
Yeah.
GameStop accumulated that stake right up to the legal threshold.
Right.
Because under SEC rules, when you acquire more than 5% of a company's voting class shares, you must file a Schedule 13D to publicly declare your intentions.
So they stayed just under the radar.
Exactly. GameStop quietly accumulated up to 4.99% using derivatives, specifically call options.
And when you buy massive amounts of call options, the market makers who sold them to you have to hedge their own risk by buying the actual underlying stock.
So GameStop's quiet derivative buying forced Wall Street market makers to algorithmically buy eBay stock to hedge.
Which drove the price up.
Yes, and when the massive premium offer was finally made public, any existing short sellers panicking to cover their positions had to buy shares at the exact same time.
Triggering a classic short squeeze dynamic.
That is the precise mechanism that sent the stock gapping up so violently after hours. The combination of market maker hedging and short sellers scrambling to exit created a massive demand shock.
So what does market sentiment look like? Because with all of these complex mechanics firing at once, you have to wonder who is actually buying into this narrative.
Well, if you look at quantitative sentiment scoring across social media and retail brokerage data, it is heavily bullish.
Really?
Yeah, and that is almost entirely driven by the sheer scale of the $56 billion premium. The headlines are framing it as a masterstroke.
I'm sure retail loves it.
Retail sentiment loves the idea of the ultimate David and Goliath M&A scenario. The original meme stock using its cult following to swallow a legacy tech giant. It perfectly validates that valuation floor we talked about earlier.
But then you have a severe divergence when you look at Wall Street sentiment. I mean, I am looking at notes from institutional analysts, and they are highly skeptical.
Very skeptical.
Analysts from Bernstein view the structure of this deal as a huge operational distraction. They are warning clients that this hostile drama risks completely derailing eBay's ongoing standalone turnaround.
And then you have analysts like Michael Patcher and Dan Ives from Wedbush.
Yeah, they are heavily questioning the basic financial physics here. How does a smaller $12 billion company physically finance the acquisition of a $46 billion giant without instantly bankrupting itself under the weight of the debt?
It is a phenomenal question. And analysts are absolutely right to be skeptical of the leverage mechanics.
Right.
But interestingly, that very skepticism is actively fueling speculative flow.
How so?
Because Wall Street doubts GameStop's ability to finance this deal domestically, heavy rumors are circulating that GameStop might be seeking backing from Middle Eastern sovereign wealth funds.
Wait, why would sovereign wealth funds step into a meme stock corporate raid?
Because sovereign funds are aggressively seeking exposure to established Western tech and e-commerce platforms.
Oh, I see.
If they can provide the capital backstop that GameStop desperately needs to secure the debt, they get a massive discounted entry point into eBay's global infrastructure.
That makes a lot of sense.
And if the market even begins to believe that sovereign wealth is stepping in, it adds immense speculative fire to the sentiment. It makes the $125 target look much more realistic.
But the reality of acquiring that capital brings us to the most dangerous part of this entire deep dive.
Now let's talk about the risks.
Because the primary bear case centers entirely on financing and equity dilution. This is a massive execution risk for GameStop.
Oh, huge. As we said, pulling off a $56 billion acquisition requires an incredible amount of leverage.
Right. GameStop has reportedly secured $20 billion in debt commitments from TD Securities.
Which is a staggering burden. Taking on $20 billion in debt at current interest rates for a company of GameStop's size.
The interest payments alone will consume a massive portion of their operating cash flow.
Yes, and it's not just the debt. To cover the remaining $36 billion of the price tag, GameStop will have to issue a severe amount of equity.
They will be printing millions of new shares of their own stock.
Which heavily dilutes their existing shareholders.
Right. If you double the number of shares in existence, the value of each individual share plummets.
Unless the combined earnings of the new mega company immediately make up for it.
Exactly. If this complex financing collapses, if TD Securities gets cold feet, or if the equity markets refuse to absorb the new GameStop shares, this entire deal falls apart.
And if that happens, eBay shares will likely lose that M&A premium entirely and fall right back to where they started.
And look, even if they manage to thread the needle on the financing, they still have to get past the government.
Yes, the regulatory roadblocks.
You noted earlier that there are severe regulatory roadblocks here that most investors aren't paying attention to. You mentioned eBay is currently under a 3-year enhanced compliance monitoring order.
Yes.
What exactly is the mechanism behind that?
It is tied to a 2024 deferred prosecution agreement with the Department of Justice involving a cyber stalking scandal from eBay's prior management. In short, previous executives engaged in a harassment campaign against a newsletter writer. As a result, federal monitors essentially have a desk at eBay headquarters right now, actively watching their compliance.
So GameStop can't just walk in, fire executives, or merge proprietary databases without federal monitors approving the compliance at every single step.
Exactly. That massively slows down any operational integration and racks up serious legal bills.
Any merger of this size has an extra layer of federal compliance friction built right into it.
And on top of the DOJ monitors, you have standard antitrust concerns. The Federal Trade Commission will heavily scrutinize the overlap in the physical and digital collectibles markets.
That makes perfect sense, because eBay owns TCG Player and Golden Auctions.
Right.
And GameStop has a massive physical retail footprint entirely dedicated to gaming, trading cards, and collectibles.
The government might argue that combining the largest digital marketplace for hobbyists with the largest physical retailer for hobbyists creates an unfair monopoly.
A monopoly that restricts consumer choice.
Yes, the intersection of those specific markets could invite strict regulatory scrutiny that delays or even blocks the combination entirely.
So with everything on the table, what's the final verdict?
Looking at all the dynamics,
Mm-hmm.
the massive premium, the financing risks, and the underlying intrinsic value, the research gives this a bullish score of 8 out of 10.
An 8 out of 10.
Yes. For you as an investor, this setup operates as a pure event-driven swing trade for the next 3 to 6 months.
Okay, so if the strategy is an event-driven swing trade for the next few months, what is the clear, long-term, multi-year investment view for someone holding the stock right now?
The long-term view is to hold into the upcoming board response and the highly probable proxy fight. You want to anchor your target price expectations to that $125 offer.
Okay.
Here is the ultimate takeaway. Even if the financing fails or the regulators block the deal completely, this hostile spotlight has permanently exposed eBay's standalone turnaround power.
It has highlighted their potential for $2 billion in internal cost optimizations.
Yes. This aggressive catalyst has fundamentally proven that the company is deeply undervalued relative to its actual earnings power and its highly defensible strategic moat.
It is a truly fascinating moment in market history, and it leaves you with a wild thought to mull over. If a meme stock can orchestrate a $56 billion raid using call options and sovereign wealth rumors, what other sleeping giants in your portfolio are completely exposed to this new breed of financial warfare? Need emergency cash. MaxLend Loans offers short-term installment loan options up to $3,750 for eligible customers. Apply through the link below and carefully review the APR, fees, repayment terms, and total cost before accepting any offer.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.